Welcome. I'm Michiel Lodewijk and I work as a partner in the financial risk team of Deloitte. I will provide you today with an introduction in the interest rate benchmark reform, which is also known as the EMIR reform. The reform of interbank offered rates, or EMIR in short, is the result of a reform that started more than a decade ago. The publication of the Principles for Financial Benchmarks, published by IOSCO in 2013, was the first major publication in this field. It started a reform that should ultimately lead to a framework for the quality and transparency of the benchmarks used in financial markets. At that time, the so-called LIBOR scandal had already been in the news a lot. Several years later, the European benchmark regulation was published, which became effective in January 2018. This European benchmark regulation aims to ensure the accuracy, robustness, and integrity of benchmarks. It refers to benchmarks as a specific index that is used in order to calculate payments of a financial contract, the value of a financial contract, or the measure of performance. The focus of the EMIR reform and the trading of today is on the interest rate benchmarks, which are rates that banks are lending or borrowing to each other or others. Hence the name interbank offered rates, which describe the rate that banks lend to one another. Most critical benchmarks, being benchmarks that are used as a reference for at least 500 billion euro, are, for example, Euribor, US dollar LIBOR, or GDP LIBOR. As already mentioned, the LIBOR scandal was the main reason that markets and supervisors became aware that a change to the old EMIR rates was required. The old EMIR rates, such as Euribor or US dollar LIBOR, were primarily based on expert judgment instead of actual transactions. This was especially the case the last few years, when interbank transactions longer than a day become more and more uncommon. However, everyday financial contracts worth trillions of euros, such as loans and derivatives, are issued, exchanged, and valued using these EMIRs. For example, a loan that refers to a 6-month Euribor rate that is issued by a company to obtain funding, or a pension fund that is hedging interest rate risk with interest rate swaps referencing, for example, 6-month Euribor. Hence, having reliable and accurate rates is very important. The consequence of the EMIR reform is that panel banks, being the banks that are in the panel based on which the interest rate benchmarks are based, need to submit their interest rate transaction data using a new methodology. However, the big impact is for users of these rates, for example as a trader, a market maker, a treasurer, an investor, a hedger, or a client. The transition away from the current EMIRs has also a significant impact on legal, accounting, valuations, risk management, and on the people performing these activities. Another relevant development as a result of the European benchmark regulation is that the so-called third country benchmarks, which are benchmarks that are administered outside the EU, will need explicit approval before they can be used inside the European Union. And this mainly impacts the administrators of the benchmarks. There are a lot of interest rate benchmarks impacted by the EMIR reform. But let's start with two key interest rate benchmarks: the EONIA, or Euro Overnight Index Average, which was a rate based on overnight transaction between banks, and the Euribor, or Euro Interbank Offered Rate, with Euribor published with several tenors, for example 1 month, 3 months, or 6 months. The EONIA was not compliant with the European benchmark regulation that we mentioned earlier. so it will cease to exist by the end of this calendar year and is replaced with ESTER, the Euro short-term rate introduced last year. ESTER is also an overnight rate, but the methodology used to determine it every day is different and in line with European benchmark regulation. The Euribor is not replaced with another interest rate. However, the methodology used to determine it daily is changed such that it complies with the European benchmark regulation. However, there are still doubts by market participants whether Euribor is the most accurate, reliable and robust rate to use in financial contracts. Hence, one of the most important questions in financial markets today is whether Euribor will cease to exist in a few years' time. That might happen if the use of it will significantly decrease and market participants move to ESTER-based contracts completely. We have shown that EONIA, the old overnight rate used for contracts in euros, will be replaced by ESTER. Similar reform can be seen for a lot of countries and markets across the globe, and often a so-called risky term rate, such as GBP LIBOR, Euribor or USD LIBOR, will at a certain point be replaced by a risk-free or near risk-free overnight rate. This overview shows the comparison between the overnight rates for the British pound, euro and US dollar. The overnight rates that have been developed for these three currencies are the SONIA, ESTER and SOFR. Each have different backgrounds and transition paths over time. SONIA was in name already the old overnight rate used for financial contracts in British pounds. However, it will be completely replaced by GBP LIBOR. This is different from Euribor and ESTER, as we just discussed, as it is still uncertain whether Euribor will cease to exist. In the US, the SOFR will replace the US dollar LIBOR rates. However, the transition path is much more uncertain and has recently been extended to 2023. Another important difference is that SONIA and ESTER are unsecured rates, so they are based on uncollateralized funding, whereas SOFR is a secured rate and based on collateralized funding. Secured and unsecured rates can behave very differently, for example in times of severe market stress, as secured contracts are more safe due to the collateral that underlies it. Another important difference between the overnight rates for British pound, euro and US dollar is the adoption of these rates. The graph shows that SONIA, in orange, is already widely adopted, while the adoption of SOFR in the US, which you can see is in blue, is lacking significantly compared to SONIA. And the adoption of ESTER, shown in green, is almost not visible in this graph and very low. A key reason for this slow transition is the important role that Euribor still plays in financial contracts and financial markets in Europe. So far, we have spoken a lot about the reform of the interest rates. There we also indicated that the big impact of the IBOR reform is for users of these rates. Think about traders, market makers, treasurers, investors, hedgers, and for example your clients. With this overview, we want to make that a bit more tangible for investment management in specific. For that, we defined 8 impacted areas. For each impacted area, this table describes the impact for investment managers in the second column. Note that these are important impacts and that other consequences can also occur. The third column describes some specific impacts on derivatives. Now, let's start with legal. Numerous contracts must be changed to include fallback language and refer to the new interest rates. Also, collateral agreements must be reassessed and renegotiated, and fallbacks must be put in place there. For risk management, activities and methodologies for interest rate hedging and hence derivatives use must be evaluated and adjusted. Valuation methodologies will change, and hence also valuations of derivatives and other financial products. This can also impact the effectiveness of hedge relationships. Interest rate swap valuations will change specifically as the underlying interest rate curves change. The amount of collateral exchanged can change as well. The EMIR reform effectively changes the valuation of derivatives and therefore also changes the amount of collateral held. The EMIR reform also has a significant impact on operations and technology. IT implementations are impacted as the new interest rates need to be incorporated in trading, deal capturing, risk management and valuation systems. Interest rate dynamics change as well as the EMIR reform results in a change from a risky term rate to an almost risk-free or risk-free overnight rate. Furthermore, the changes to the reference rates used in derivatives creates potential basis risk. The EMIR transition path impacts the liquidity for current and new interest rate products. The resulting availability of derivatives on specific interest rates will impact your ability to hedge interest rate risks. And finally, cross-currency or foreign exchange impacts, as the new overnight rates can show different behavior of forward rates. And the EMIR reform also changes the interest rates underlying cross-currency swaps. This brings us to the end of this presentation. I hope you enjoyed this session and I wish you success with the preparations for your MiFID assessment. Thank you for watching.